Okay, let's dive right in. You've handed us, well, quite a stack of sources here, all focused on this pretty fundamental fork in the road for personal finance: saving versus investing.
Yeah, and on the surface, they can seem kind of similar, right? Both involve setting money aside.
Exactly. But digging into these materials, it becomes clear they are really very different tools
Yeah.
for different jobs.
And that difference, these sources really hammer this home. It's absolutely critical. Getting them mixed up or just not knowing when to use which one.
That could really hurt your financial health down the line.
Definitely. It can impact your security now and your growth potential later. So our mission here really is to unpack what these sources say, pull out those core differences.
And make it super clear why you actually need both for, a solid financial life.
Precisely.
All right, let's start with the bedrock, saving. What are these sources telling us is the main point of saving money?
Well, fundamentally, saving is about putting money aside for, let's say, nearer term things, needs, or unexpected events. The sources point to two main goals here. Capital preservation, basically, keeping your money safe, not losing it, and liquidity.
Liquidity meaning you can get to it easily.
Exactly. Quick and easy access when you need it.
So safety and speed of access.
Yeah.
Where do the sources suggest people actually do this saving, the practical places?
They list the usual suspects, the low-risk options. You've got your standard bank savings accounts, probably not earning much interest.
Right.
Then money market accounts, often similar, maybe slightly better interest rates. Sometimes you can write checks, but still very focused on stability.
Okay.
Certificates of deposit CDs, those get mentioned too. That's where you lock your money away for a set time.
Like 6 months, a year?
Yeah, something like that for a fixed interest rate. But, and this is key, there's usually a penalty if you need to pull it out before that term is up.
Got it. And I guess technically stuffing cash under the mattress is saving too, though maybe not the best plan for large amounts.
Right. Technically, yes. But the defining things about saving, according to these sources, are, number one, very low risk. The chance of actually losing your initial money is tiny, especially with things like FDIC insurance in the U.S. for bank accounts.
Right. That insurance provides a safety net up to a certain amount.
Up to $250,000 per depositor per insured bank, yeah. And number two is that high liquidity we mentioned.
Knowing the money's right there, immediately available, that feels important.
It's crucial. But there's always a trade-off, isn't there? And the sources highlight this again and again. The downside is low returns.
Yeah, you're not going to get rich off a savings account.
You're really not. The interest earned often, it struggles just to keep up with inflation. One part I read even pointed out that historically, average savings account returns have often been lower than inflation.
Wow. So your money is actually losing buying power, just sitting there.
That's the risk. It's not just that you're not making much. You could actively be falling behind as prices for everything else go up.
Okay, that's a really important point. So given those, frankly, kind of crummy returns, why do all these experts insist saving is so vital?
The number one reason, hands down, is the emergency fund.
The rainy day fund.
Exactly. The sources are pretty much unanimous on this. You need a buffer, typically 3 to 6 months worth of essential living expenses.
Stashed away in one of those safe, easy access accounts we just talked about.
Yes, that's your first line of defense. Job loss, unexpected medical bill, car breaks down. Without that cushion, any financial shock can just completely derail you.
It's like the financial foundation of your house. Needs to be
I
solid.
couldn't have said it better. And saving is also perfect for those more defined short-term goals.
Like what?
Things you know you'll need money for relatively soon, maybe in the next few months, up to maybe 2-3 years out. Think a down payment for a car, saving up for a big vacation, a new washing machine, even just planning for holiday spending.
Okay, that makes sense. Near-term, predictable stuff.
And there's one more strategic use mentioned. Saving up specifically to pay down high-interest debt.
Like credit cards.
Exactly. Because the interest you stop paying when you clear that debt, that's like a guaranteed return on your money. And it's often a much higher return than any savings account could possibly offer you.
That's a smart way to think about it. Okay, so saving. Safe, liquid, short-term focus, low returns. Primarily for emergencies and those near-future goals. Got it. Now let's shift gears. Investing. The sources seem to frame this as, well, a whole different ball game.
It really is. This is where you're putting your money out there with the specific goal of making it grow or maybe generating income from it over time.
So not just keeping it safe, but actively trying to increase it.
Right. Investing, as defined in these materials, is allocating your capital hoping to increase its value or earn returns, ideally beating inflation by a good margin.
And the absolute key difference from saving is
Risk.
Yeah.
And tied to that, potential return. Investing just inherently means taking on more risk than saving.
but you do that risk-taking for the chance of getting much better results.
Exactly. For the potential, and that word potential is important, of achieving much higher returns, especially over the long haul.
Okay. Now, the places you can invest, the sources, list a ton of options. It's way more varied than just savings accounts or CDs.
Oh, absolutely. It's a huge landscape. You can buy stocks owning small pieces of companies, hoping their value goes up or they pay out profits as dividends.
Right.
There are bonds. That's more like lending your money, usually to a government or a big corporation for a set time. They pay you interest along the way, and then your original amount back at the end.
Okay, stocks and bonds, the classics. What else?
Then you get into funds that bundle these things together. Mutual funds are a big one. Portfolios of stocks, bonds, maybe other things, all managed by a professional.
So you get diversification easily.
Yeah, diversification is a key benefit. And then exchange-traded funds, ETFs. Kind of similar to mutual funds in that they hold a basket of assets, but they trade on stock exchanges like individual stocks do all day long.
Yeah.
Real estate, buying actual property to rent out or hoping it appreciates, that's another major investment category mentioned.
Can't forget property.
And of course, retirement accounts. Things like 401ks, which many people get through work in the US, or IRAs, individual retirement arrangements. These are specifically designed for long-term investing.
And they often come with tax advantages, right?
Big time. Often tax-deferred growth, meaning you don't pay taxes on the gains year after year, which really helps compounding.
The sources even mention some newer or maybe riskier areas.
They do. Cryptocurrencies get a mention, highlighting their volatility, and commodities, things like gold, silver, oil, it just shows the sheer breadth of what investing can cover, each with its own risk profile, its own liquidity level.
It really drives home that investing isn't just one thing, it's a whole category.
Exactly. But across all these different types, the sources pull out some common traits. First, as we said, higher risk. Unlike saving, there's a real possibility your initial investment could go down in value, especially in the short term.
Yeah, that's the part that makes people nervous, I think. The idea of losing money.
It definitely can be intimidating, but the sources also provide important context here. They point to historical data showing that if you have a diversified portfolio and you stay invested for the long term, think decades, not just months or a year.
The odds shift in your favor.
Historically, yes. The tendency over long periods has been strongly towards positive returns, often well above inflation rates. But patience is key.
Okay, so higher risk. What of getting your money back out? Liquidity again.
Generally lower liquidity than saving. Selling investments isn't always instant. It takes time to execute trades. And if the market happens to be down when you need the money,
You might be forced to sell at a loss.
correct. So you can't count on getting your full investment back immediately, anytime, like you can with a savings account.
But the flip side, the reason people take that risk and accept lower liquidity, that's the potential for higher returns.
That's the big prize. This is how you really build wealth over time. The sources talk about the power of compounding.
Ah, yes, the magic of compounding.
It really is powerful. Earning returns not just on your initial money, but then earning returns on those returns. Over many years, it can lead to, almost exponential growth.
Making your money work for you.
Precisely. One example showed how even small, regular investments over, say, 20 or 30 years could balloon into a surprisingly large amount, way more than just the sum of your contributions, because the earnings themselves start generating more earnings.
That compounding effect really underscores the importance of starting early, even if it's small amounts.
Absolutely. And it points to the final key characteristic the sources highlight. Investing is typically for the long term.
Right, not for money you need next year.
Generally not. It's for goals that are years, maybe decades down the road. Retirement is the classic example, of course. But also maybe saving for a child's education fund way in the future, or a house down payment you won't need for 5 or 10 years.
So, summing up investing, it's about aiming for substantial growth over time, beating inflation, and hitting those big long-range financial goals.
You got it. Wealth creation, essentially.
Okay, we've looked at saving, we've looked at investing, pulled out their traits from these sources. Let's put them head to head now. How do the sources summarize the direct comparison?
They lay it out quite clearly, often in tables or summaries. Purpose. Saving is about safety, emergencies, short-term goals. Investing is about long-term growth, building wealth,
Okay.
time horizon. Saving short to medium term, investing long-term, many years out.
Makes sense.
Risk, saving very low, investing higher, potential for loss exists.
Got it.
Returns, saving low might not beat inflation. Investing potential for much higher returns aims to significantly beat inflation over time.
And finally, access.
Liquidity. Saving highly liquid, easy access. Investing in generally less liquid takes time, potential to sell at a loss if needed quickly.
It really paints a picture of two distinct tools for different financial jobs. The sources had a good analogy for this, didn't they? Something about a house.
Yeah, I like that one. They described saving as building the strong, solid foundation for your financial house.
Okay, the essential base.
Right. It provides the stability, the security. You absolutely need it.
And investing is.
Investing is like adding the upper floors, the extra rooms, expanding the house upwards and outwards. It's how you significantly grow the size, the space, the overall value of your financial dwelling over time.
Love that. And you can't really have a big, valuable, comfortable house without both, right? You need that solid foundation and the growth on top.
Exactly. The sources are really clear on this. It's not saving or investing. It's saving and investing. A balanced approach uses both strategically.
Okay, so if you need both, how do you balance them? Did the sources give a kind of roadmap?
They do, a pretty common sense one. Priority number one.
Let me guess. The emergency fund. Build the foundation first.
You got it.
Like those credit cards we mentioned earlier.
Exactly. Because the interest rate you're paying on that debt is often so high, eliminating it gives you a better, more certain financial boost than the potential gains from early investing, especially when you factor in risk.
That makes total sense. Get the foundation secure, patch up any expensive leaks like high-interest debt.
And then once that's under control, you start confidently allocating money towards your long-term goals through investing. You start building those extra floors on your solid foundation.
It's a logical progression. Stability first, then growth.
Mm-hmm.
Now, for someone listening who's maybe just starting out or perhaps feeling a bit overwhelmed by all this, the sources had some words of encouragement, didn't they?
They did. A key message was about just getting started with investing, if you haven't already. The classic line, the best time to start was yesterday.
The second best time is today.
Exactly. Don't wait for the perfect moment.
And they also stress that you don't need huge amounts to begin, right?
Not at all. Even small, consistent contributions can make a huge difference over the long run, thanks to that compounding effect we talked about. Consistency is often more important than timing the market or having large sums initially.
So the advice is basically, don't let fear or feeling like you don't know enough hold you back.
Right. Start small, commit to learning as you go, educate yourself step by step.
And if things feel too complex or your situation is unique,
the sources generally suggest considering talking to a qualified financial advisor, someone who can give personalized guidance based on your specific goals and circumstances.
Okay, great. So bringing it all together, understanding this distinction, saving versus investing, knowing when to use each one, it really seems like a foundational piece of managing your money well.
It absolutely is. They're not enemies, they're partners. Each has a vital but different role to play.
It's about having the right tool for the right financial job.
Precisely. And thinking back to that point about inflation, how it silently erodes the value of money that's just sitting there, not really growing.
Yeah.
It really makes you think, doesn't it? It poses a question these sources kind of lead you to. For your long-term future, at what point does the hidden cost of playing it too safe, the cost of not putting your money to work through investing, actually become a bigger risk than the volatility of the investments themselves?
That's a powerful question to leave people with. When does staying still become riskier than moving forward? Food for thought.